I mean, they're some are up, but up small. Tushar Pradhan is with us, director at HXGON Partners. Tushar, good to have you with us here. Let's just start with this IT space. I mean, actually, if you look at the IT index, it's down 25% from the beginning of this year. What are your thoughts, Tushar, and anything you like here?
I think the reason why most of them are down clearly is because of an indirect impact of the tariff. So people are expecting that the US might go in a recession because of the challenges faced by the tariff regime, and as a result of which, US companies will be then constrained in terms of their IT budgets, etc., and that is actually been seeing having an impact on the stock prices. But I think that is maybe a second or third level impact that we need not be excited about at this time. And I think it is very necessary to kind of keep a close focus on the actual number rather than the sentiment here. Having said that, I think you have to remember that pre-COVID, most of these companies were trading at multiples which were much less than what the multiples even now are after a slight correction in most of their prices, which tells you that in a more benign environment, IT companies had come down to a level which was more or less a par for the course kind of year-over-year dollar revenue growth rate. And because of the COVID impact, the base impact took the revenue and the earnings growth significantly higher for the last 2 years. But if you're going now forward, I think we should be ready for a much more, I would say, muted multiple for these companies going forward. Again, nothing wrong in terms of the business model, etc. But I think the base impact is behind us. So I think the prices may adjust downward to a much more average multiple going forward. As a result of which, I think the only excitement I see in this place is about more specific areas of growth where the continuation of the earnings growth can be significant. But the larger, more diversified IT players may be more in for a more benign time from here on.
So do you have IT in your portfolio at all, Tushar?
Yes, we do. And as I said, it is more to do with the smaller, more, I would say, focused IT offerings, which we like, as opposed to the more generic IT space as such.
So what are they focused on? If you could just give us some indication. Are they the ER&D plays focused on auto? Are they some of the mid-cap IT companies which are growing much fast, but they have a discretionary exposure? What are the companies that excite you right now?
So we, at the moment, are excited about auto in specific. So what we understand is that increasingly the value for any automobile going forward is going to be more in the electronics than in the machine. As we all know, anyway, the ICE is going to be replaced by an EV. But more importantly, it's the gadgetry, which is really the critical aspect for a differentiation between one automobile versus the other. And I think anything which services this area, whichever way you look at it, is going to be of interest. And the percentage increase in the value for the automotive going forward clearly will come from here. So any company servicing that area, that's a principal interest. There are other interesting companies which go into a lot more specific area of travel, etc., which also are fairly interesting, but we don't hold them as of now.
You were also looking to add Select Pharma when we last spoke to you. Where do you stand? I mean, have you already added to your positions in pharma? Is it the CDMO space? How are you thinking about pharma right now?
Pharma is in a fairly interesting space, I must say, because of the whole, expected level of new tariffs to be added from here on. But having said that, I think Indian pharma continues to remain in a very strong space. There are companies which we like in the CDMO. There are companies which we like in the generic pharma space, because that will continue to remain one of the bright spots going forward, no matter where US healthcare costs go. Because whichever way you look at it, I think the direct impact of tariffs would be on customers who pay for healthcare going forward. And I think there will be extra care to ensure that the medical costs, which already are fairly high in the US, do not shoot up due to pharmaceutical costs. We all, of course, agree that the pharmaceutical cost is a smaller component of the total healthcare cost for anyone anywhere in the world, especially in the US. But that will still be a relatively bigger impact for consumers. So I think this is a fairly protected space from what I gather, and that's why I feel continued to be excited about the Indian pharma space. But as I said, nothing specific at this time. There are areas in generic pharma and the CDMO space which are very attractive to me right now.
Tushar, hi. Good to be listening into you this afternoon. So just a question on the broader market. I mean, for a moment, if we just let go of the global tariff headlines, and for a moment, if you assume that the worst of the financial market damage maybe is over, the crazy volatility, 6-7% swings on a daily basis. If we leave that aside and focus on the rest of the cues here, which is whether it's flows, whether it's the earnings recovery, then how much would you give this market over a 12-month horizon? I mean, will we get back to our winning ways, or do you see a prolonged patch of consolidation ahead?
Yeah, so I think I clearly want to distinguish between markets and the earnings growth, because over the long run, we all know that the markets do follow earnings growth. But in the interim, even if you have strong and robust earnings growth, which we clearly expect in FY26 as well as 27 especially, if the sentiment is blurred by either an ongoing trade war which takes longer to resolve, or actual impact on the economies leading to recession in the US, for example, then your domestic earnings growth is not going to actually get the limelight. When I call limelight, I mean the multiple it deserves. So earnings growth may roll in. Economic growth can be shown in various parameters. You will see IIP growth continue to be very strong. However, the markets may not want to respond because of the sentiment being bad. So I think this is really where I draw the line in terms of the estimate for what we think the market is likely to do. But if you ask me what is the prospect of earnings going forward, I think the domestic economy continues to remain a bright spot. If you look at all of the things which have happened in our economy lately, and the possibility of continued investment into production and maximization of capacity utilization from here on, with the kind of demographics that we continue to have, I think the Indian economy is going to be a bright spot for a long time. Having said that, if international capital starts to identify that and would want to participate in the markets, I think that will be the kind of silver lining that we would like to see for the case that we have to make. So if you were to ask me, are earnings going to remain robust? I would think so. Would you think the market would react to that? That's a matter for global news at that time for us to kind of take a look at.
All right, Tushar, thank you very much for joining us. It's a pleasure having you with us here on CNBC-TV18, and I look forward to our next one. Have a good weekend. I think we all need it. Let's take a quick commercial break.